Good morning, everyone. We are here today to present our research on a topic that holds significant importance in the current economic landscape, especially concerned non-profit organizations. So this research has been undertaken as part of our coursework for research method in economic subject. So our study delves deep into financial vulnerabilities within non-profit sector. Our research is titled Unmasking Non-Profit Risks, Insights from Financial Vulnerability Analysis. So through this study, we aim to shed light on the underlying financial vulnerabilities that non-profit face and how these vulnerabilities can pose risk to sustainability and creditability of these organizations. So me representing our research team today, myself, Amr Fahmi, Omar Faqera, Johnson, and Ali. Together, we have spent significant time and effort in ensuring this research is both comprehensive and relevant. So now I will start with the introduction. Today, let's talk about management fraud, a pressing issue with serious global repercussions. We have seen the fallout from fraud in major companies like Enron and WorldCom. But it's not just these gains. Globally, organizations are losing over 2 million on average to economic crimes over 2 years, with an alarming rise in fraud trend from 5% of annual revenue in 2002 to 7% in 2010. So this issue isn't restricted to the corporate sector. It's infiltrating non-profits too. So organizations like Plant Aid Canada and NNACP have suffered financial scandals, promoting calls for stronger governance and accountability in this sector. So non-profits, although non-profit driven, which are not immune to economic uncertainties, they are susceptible to financial vulnerabilities, especially during economic downturns when funding might decline or cease. So this brings us to the heart of our study. We are utilizing financial ratio, tools commonly used by financial analysts to predict business failure and fraud. So to assess the risk of financial vulnerabilities in nonprofits. Building on the work of Tuckman and Chang from 1991, our study introduces four new financial indicators to their model. The goal to help regulators pinpoint high-risk nonprofits and hopefully curb management fraud in the sector. We are excited to dive deeper into this topic with all of you as our study progresses. Okay, now I'm going to discuss more about the problem statement of the study. As we know that financial vulnerability is akin to the weakest link in an organization chain. It defines the susceptibility of groups' financial foundation to face crisis. This can lead to the significant financial strain and open the doors to potential fraud and misconduct. In fact, organizations under financial distress are more prone to fraudulent behaviors, as previous studies have pointed out. For nonprofit organizations, this is practically concerned. Why? Because their stakeholders, people deeply invested in the success of these organizations, view financial vulnerability as a major threat. This is because it directly affects resources, compliance with regulations, and the overall survival of the organizations. So MPOs have certain characteristics that may amplify their financial vulnerabilities, from enjoying high public trust, operating with less strict regulatory framework, or even lacking the expertise to manage and navigate their unique challenges. So when the economy gets tough, these organizations often experience a dual challenge: reduced funding on one hand and surge in demand for their services on the other. So this is where our study comes into the picture. Building open foundational work by Tuckman and Chang in 1991, we are proposing the use of financial ratio as tools to gauge the risk of financial vulnerabilities in MPOs. So the aim is to understand just how exposed these organizations are to such risks. So with the Financial Action Task Force, uh, which recommending a risk-based approach. So our study findings are intended to guide regulators. This will allow them to identify and closely monitor MPO, which face a high risk of financial vulnerability. Uh, in summary, our study isn't about identifying a problem. It's offering a solution and ensuring our cherished non-profits can weather any storm and continue serving our communities. So now, as you can see, here is our research questions and objectives. So as you can see, our first research question: what is the significant influence of internal factors on non-profit organizations' financial vulnerability? Which is answered by to determine the impact of internal factors on the non-profit organization financial vulnerability. The second one is what is the significant impact of external factors on non-profit organization financial vulnerability, which is also answered by to determine the impact of external factors on non-profit organization financial viability. So the last one is what is the significant influence of internal and external factors of the organization's uh, financial vulnerability, which also answered by to determine the impact of external and internal factors on the performance of the financial vulnerability. So now, as you can see, here is our theoretical framework. This theoretical framework was created to show the relationship between the underlying theories, which is the independent factor, which is ROA, and solvency ratio, suitability ratio, efficiency ratio, and surplus margin are some of the internal variables that were calculated in this analysis. So the macroeconomics indicators, which are inflation, GDP growth, and interest rate are the external factors in this analysis, which is the organization's financial vulnerabilities. So to make it clear for you, as you can see here, we have made this table to show you the variables and how we measure it. So as you can see, so for example, for solvency ratio, we will measure it by debit ratio and cash ratio. And also it goes to for other variables as you can see in the table. So as you can see here, for our population and sampling method, for our population it will be non-profit organizations, and for sampling method it will be two non-profit organizations from two different countries to show the to I mean like to have a reliable data. And for data collection it will be secondary data from annual reports, and the sample size it will be 5 years, and we will use SPSS software to run this analysis data.
Hi everyone, I'm Jensen, and now I would like to continue for the data analysis and interpretation. So here is the raw data and ratio calculation for the International Cancer Control. From here, we have taken the data from 2017 to 2021 with giving up the debt ratio, cash ratio, stability ratio, efficiency ratio, also the surplus margin. Here we generate out the ROA, debt ratio, cash ratio, stability ratio, efficiency ratio, surplus margin, GDP, inflation rate, and interest rate from the year 27 to year 2021. From there, we have given the mean and standard deviation calculate for this non-profit organization. While we have the GDP, inflation, and interest rate as the external factors. First of all, here is the descriptive statistic from the 8 internal variables and we come out these 6 variables of ROA, cash ratio, stability ratio, efficiency ratio, inflation rate, and interest rate. We can see the number correct is 10. That means we combine those two non-profit organizations to have the statistic come out. Now we would like to talking the coefficients. From this model, we can see that the cash ratio is the only one significant that shows a positive significance to the ROA with the p-values of 0.063. On this dependent variable of ROA, we can see that the range between 0.01 to significant 0.1 shows a positively significant. Therefore, from here we would like to reject the stability ratio, efficiency ratio, inflation rate, and the interest rate. Now, the correlation, we have taken the Pearson correlation, and here is showing the significance to 1 to that the correlations on ROA and cash ratio showing a 0.004. That means the cash ratio is significantly important with related to this ROA. Well, we can look at the stability ratio, this showing a 0.051. That means this slightly important that because showing a value near to 0.05, that means the ROA and stability ratio is somehow important. While we're looking on the efficiency ratio, inflation, and the interest rate, there are more than 0.05. That means these are not related on the ROA on correlations. Here we would like to talk about the model summary. From this model, we taken the internal and external factors to investigate what is the relationship from the financial report, the values which relate on this model. So from here, the R square showing a 0.802, that means 80.2%, which are significant or can be stated as this is a good fixed model for this study. But we take a look on the adjusted R square, that's only showing a 0.554. That means there's only a 55.4% related to this model. So from here, they just showing a mutual relationship to the model. Lastly, this is the ANOVA table, which show the model relate to regression and residual. From here, we can see that the significance shows a 0.139. That means the p-value showing a 13.9% that the non-profit organization is higher than the normal significant level of 0.05, which is higher than the 5%. So from here, the table 4.5 showing that the independent variable on the financial vulnerability of the selected non-profit organization is not adequately explain the variation in ROA concerning of this financial variable.
Implication: the null hypothesis in SPSS assumes that there is no significant difference between groups being compared, but the value is higher than the significant level shows that there is no evidence to support reject the null hypothesis, and research conclude that there is no statistically significant difference between the group. For the previous slide, the model brings the result on no significant variance in both internal and external factors. On the financial vulnerability and non-profit organization, considering implication and suggestion for the further study, it's essential to explore other potential factors that could contribute non-profit organizations. Some of the additional factors other than internal and external focus may be considered to investigate future study. Fundraising strategy, investigating the effectiveness and various fundraising strategy to mitigate financial vulnerability and sustaining financial stability. Government and leadership studied the impact of the strong government and effective leadership, ensuring financial accountability and sound financial decision making with a non-profit organization. External partnership, assessing, evaluating strategic partnership and with other organizations or entities. Enhancing financial stability and resource mobilization. This knowledge can be valuable to develop target strategy and policy to enhance the financial resilience and sustainability to non-profit organizations, ultimately enabling them to better fulfill their mission and serve the community effectively. Recommendation of the study and conclusion. There are 3 models were used in this study. The study data were limited into the previous 5 years, which is 2017 to 2021. That may minimize the study accuracy in terms of supporting the research, expanding the time, increasing the test sample size, and adding additional variable into the study. Thank you.